Welcome to today's Explainer. We're jumping right into a completely fascinating topic that totally flips the traditional script on how we look at the stock market. We are going to decode the actual math and honestly the psychological mindset you need to build true generational wealth. We're stepping way beyond basic numbers today to look at the human brain, specifically why our very own natural instincts actually hold us back from making the big money. So get comfortable because we are going to completely dismantle the illusion of perfection in investing.
To kick things off, let's just think about a really fundamental question. When you picture the world's absolute greatest, legendary billionaire investors, what do you think their track record actually looks like? Do you think they possess some sort of flawless crystal ball ability where they only pick winning stocks? Like everything they touch just turns to gold? We instinctively assume that to be a billionaire, you've got to be right almost all of the time, right? Well, hold on to that thought, because the data paints a very different picture.
The core misconception we all suffer from is basically this myth of perfection. The myth tells us these legends have a flawless track record, but the reality? It's honestly a bit shocking. The greatest portfolios in the entire world are absolutely littered with failures, bankruptcies, and companies that just went nowhere. Their massive wealth is actually driven entirely by just a tiny handful of astronomical winners. Grasping this reality is step one to curing what psychologists call loss aversion. That's that paralyzing fear of picking a loser. Because the reality is, even billionaires pick losers, all the time.
To really understand how this works, you just need to keep one single number in mind: 3. Take the portfolio of the late legendary Indian investor Rakesh Jhunjhunwala. People often call him India's Warren Buffett. Throughout his career, he typically held a portfolio of roughly 30 major stocks at any given time. But out of those 30 bets, do you know how many generated the vast, overwhelming majority of his monumental wealth? Literally just 3. Out of 30 bets, he only needed about 3 legendary home runs.
Let's actually break down that portfolio math. At one point, his total portfolio value crossed a staggering 50,000 crore rupees. But an unbelievable 20,000 crore rupees of that total wealth came from just one single stock, Titan Company. Think about that. A massive chunk of his other investments completely failed or just sat there doing absolutely nothing for a decade. But mathematically speaking, when you have one winner that returns thousands of times your original investment, it totally eclipses dozens and dozens of failures. You definitely don't need a perfect track record. You just need to catch a few absolute giants.
Section 1. Portfolio Math and the Power of Baskets.
So if catching that one massive winner is the secret, how do you actually guarantee you find it without a crystal ball? Well, the massive investment firm Tiger Global realized they couldn't perfectly predict the future either, so they utilized what's called the basket strategy. Back around 2008, they knew for a fact that the e-commerce sector in India was going to explode, but they have literally no idea which specific startup would become the ultimate champion. So instead of agonizing over picking the one perfect company, they invested in multiple competing companies all at the same time. They mathematically accepted that some would go totally bankrupt, but by buying the whole basket, they guaranteed they'd own the ultimate market leader.
The results of this strategy are almost cinematic in how extreme they are. Tiger Global put money into a company called ShopClues and lost roughly 700 crore rupees, a complete wipeout. For an everyday investor, a 700 crore loss would trigger massive panic and ultimate loss aversion. But because they also bet on Flipkart in that exact same basket, they eventually saw a return of over 50,000 crore rupees. That massive loss on ShopClues, it literally just became a rounding error. Compared to the astronomical gains from Flipkart, the basket strategy absolutely works.
And the crazy thing is, they didn't just get lucky once. They repeated this exact same formula in the stock brokerage sector. They saw the discount broking wave coming, so they just funded Grow, Upstocks, I&D Money, and CoinSwitch, 4 fierce competitors, all at once. Fast forward to today, some are market leaders, some are definitely lagging, but because they cast that wide net over a rapidly growing sector, they successfully secured the market leader again. They literally engineered a scenario where it was mathematically impossible to miss the big winner.
Section 2. The Patience Premium, or why holding massive winners is everything.
Now, finding the winner is really only half the battle. The hardest part? It's resisting the deeply human urge to cash out early. Let's look at the dramatic timeline of that Titan stock we mentioned earlier. Back in 2003, Jhunjhunwala bought shares of Titan at just 3 rupees during a major labor strike. By 2005, the crisis was over, the business was booming, and the stock jumped to 27 rupees. That is a 9x return in just 2 years. Now, human psychology guarantees most of us would have sold right there. We take the quick profit, pat ourselves on the back, and walk away. But the billionaire mindset is entirely different. By holding through decades of wild volatility, that $3 stock soared to over 4,200 rupees today.
Just let that number sink in for a second. A 100,000% return. That kind of insane wealth is not created by aggressively trading in and out of the market every few weeks. It is mathematically impossible to achieve this without practicing extreme, frankly agonizing patience. True wealth is simply the premium you earn for having the psychological fortitude to sit perfectly still and do absolutely nothing while your winners keep winning.
Which brings us to a really core psychological rule of investing. As long as the business is growing fast, stay invested. It sounds so simple, right? But it goes against every single instinct we have to secure a quick win. If the company's revenues are climbing, if their profits are multiplying year after year, you have to ignore the stock price fluctuations. Holding on to a fundamentally strong, rapidly growing company instead of cutting it loose for a quick dopamine hit is the ultimate wealth mindset.
Section 3. The Index Reality and an Ecosystem of Survival.
Now, I know you might be thinking, well, this basket approach is only for billionaires with deep pockets. But this exact same survival of the fittest math applies to everyday index investors too. Let's look at the 25-year survival rate of the Nifty 50, the index representing the 50 largest companies in India. The data is honestly mind-blowing. Out of the 50 original companies that made up the index 25 years ago, 40 of them have completely vanished, failed, or just been replaced by better companies. Only 10 of those original giants survived until today.
And right here is where the absolute magic happens. Despite a bloodbath of an 80% casualty and replacement rate among the individual companies over 25 years, the Nifty 50 index as a whole still delivered a stellar 13% compound annual growth rate over that period. The index acts exactly like a billionaire's portfolio. It automatically weeds out the losers and lets a few massive, unstoppable winners drive the overall growth.
This brings us face to face with the ultimate psychological enemy we've been unpacking today: loss aversion. It's that deep-seated, totally natural fear that a stock might go to zero, and it completely paralyzes us from taking the calculated risks needed for big long-term gains. But as we've seen from Tiger Global all the way to the Nifty 50, losing on individual bets is completely normal. The data proves that you can be wrong a huge amount of the time, suffer heavy individual losses, and still come out incredibly wealthy if your portfolio is structured for reality. So what's the grand takeaway from this explainer? It boils down to adopting the ultimate wealth mindset. First, embrace the math. Accept that some losses are completely inevitable. It's just part of the game. Second, use diversification, not just as a safety net, but as a trap to capture those ultimate massive winners. Third, fight your own psychology and resist the urge to sell a growing company too early. And finally, focus on the total ecosystem of your portfolio, not the individual failures. Do not let one bad apple make you abandon the entire orchard.
I want to leave you with this final, somewhat provocative thought. Ask yourself, are you optimizing your portfolio for a perfect track record just trying to avoid being wrong, or are you actually optimizing for true, life-changing wealth? Because as we've clearly seen today, those two things are very, very different. It's time to let go of the illusion of perfection, embrace the mathematical reality of long-term investing, and truly let your winners run. Thanks for joining me on this explainer, and I will catch you in the next one.
How do businesses actually build billion-dollar empires? I mean, it is the ultimate fundamental question of wealth creation, isn't it? Whether we are talking about a massive, sprawling conglomerate or just a small local shop trying to expand its footprint, the core engine of that growth always traces back to one single thing, and that is capital. So today, we're going to unpack exactly how the world's most successful businesses actually fund their growth. And more importantly, we're going to look at how the smartest investors ride that exact same wave to build unimaginable wealth.
All right, let's jump right into this. Welcome to This Explainer. Today, we are bringing you the ultimate market masterclass. We're going to distill decades of market history, billionaire investment strategies, and core financial mechanics into a really clear, straightforward blueprint. We are skipping all the complex Wall Street jargon and looking straight at the actual underlying logic of the stock market. Here is our roadmap for today. We'll be hitting the capital dilemma, the history of shared risk, the methodology, the billionaire masterclass, and capping it off with the power of diversification. Let's get to it. Section 1, the capital dilemma, funding a business expansion.
Okay, picture a local electronics shop owner. Let's call him Jeff Halal. Now, Jeff Halal wants to expand his business online, but to do that, he desperately needs funding. He basically has two choices here, debt or equity. If he goes with debt, say he takes out a hefty bank loan, he absolutely has to repay that principal plus the interest no matter what happens. Now, that's a nice fixed return for the lender, sure, but it carries a huge bankruptcy risk for his business if things suddenly go south. But what if he chooses equity? Well, he goes to his friends for money in exchange for a percentage of ownership in the business. Suddenly, there is no fixed repayment. If the company fails, everyone loses together, which actually means a really low bankruptcy risk for the business itself. But if it succeeds, the partners share all of the wealth. Let's look at the math here, because the upside of shared growth is honestly massive. Sayed Jedalal asks his friends to invest 10 lakh rupees for 10% equity in his new company, which right now is valued at 1 crore. Well, if that business booms and hits a valuation of 100 crores, that 10% equity doesn't just pay out some tiny little interest rate. No, it's suddenly worth 10 crores. The investors became partners, they took on the shared risk, and they reaped an absolutely enormous reward. Moving on to Section 2. History of shared risk. The centuries-old system of shared reward. You know, this whole system of trading capital for equity, it's not some modern invention cooked up by Wall Street bankers. Not at all. Way back in 1602 in Amsterdam, the Dutch East India Company was sending these wooden ships across the ocean. It was incredibly risky. I mean, a single cyclone could sink a ship and literally destroy the entire investment. Naturally, banks wouldn't touch that kind of risk. So they asked regular, everyday people to pool their money together in exchange for a share of the profits if the ship actually returned safely. The risk was shared, and so was the wealth. And honestly, this idea just spread like wildfire. By 1801, the London Stock Exchange had formed. Then it hit India. In 1875, a group of merchants started trading under a literal banyan tree in Bombay, which became the Bombay Stock Exchange. And eventually, in 1992, the National Stock Exchange was established. The core mechanism here, funding massive growth by sharing the risk, has stayed exactly the same for over 400 years. And think about it, without public stock exchanges, these immense business expansions just wouldn't be possible without completely drowning a company in crippling debt. Take Wipro. Back in 1945, their founders used the Bombay Stock Exchange to fund a factory in the tiny village of Amaliner. Or look at Dhirubhai Ambani in the late 1970s. He needed massive, unprecedented capital to build Reliance. He didn't just walk into a bank, he went straight to the public. He literally held investor meetings in massive football stadiums in Mumbai, pitching his vision directly to regular people. The folks who believed in his fundamental business growth and bought equity, they made incredible, generational wealth. Section 3. The methodology. Fundamental versus technical analysis. So if equity is the true path to wealth, how do you actually choose what to buy? Well, there are generally two camps out there. You've got technical analysis, which is basically staring at short-term chart patterns, and then you have fundamental analysis. Benjamin Graham, who famously mentored Warren Buffett, summed it up perfectly. He said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Basically, short-term price movements, that's just emotional noise. It's just people voting based on whatever the current trend is. But over the long term, a share price acts strictly like a weighing machine. It accurately reflects the actual weight, the true core growth, and the hard profit of the business. So fundamental analysis is absolutely the key. It's the exact methodology that legendary investors rely on. But how do we actually go about weighing a company? Well, to really evaluate a stock's value and efficiency, you have to look at three absolutely crucial valuation ratios. First up is market capitalization. Think of market cap as the complete buyout price. If you wanted to own every single piece of the pie today, this is the massive check you'd have to write. But a giant price tag doesn't mean it's actually a good deal, right? That's where the PE, or price-to-earnings ratio, steps in. This is basically your reality check. It tells you exactly how much you're paying for just one single dollar of the company's profit. Or, to put it another way, how many years you'd have to wait for the business to just earn back what you paid for it. And finally, we have ROCE, return on capital employed. I like to think of this as the company's internal engine efficiency. When the business pumps the dollar back into its own operations, how much actual, tangible profit does that engine spit out? The smartest investors in the world aren't staring at squiggly lines on a chart. They're looking right under the hood at this engine. And when you actually weigh the fundamentals like that, the math just becomes undeniably clear. Look at TVS Motors. They saw massive underlying growth, going from 8,000 to 50,000 crores in actual revenue. The impact? Their share price grew 7 times over in just 5 years. On the flip side, look at Videocon. Their revenue consistently declined, their profits turned negative, and as a result, their share price crashed in year 0. Or even take Ola Electric recently, where mounting continuous losses have caused a really significant drop from its peak.
Over the long haul, the share price strictly always follows actual business revenue and profit.
Section 4, the billionaire masterclass, decoding the world's most successful investors.
100,000%. Yeah, you heard that right. That is the absolutely staggering return generated by the legendary Indian investor Rakesh Jhunjhunwala on one single investment. Let's break down exactly how he actually pulled that off. The company was Titan. Jhunjhunwala, using strict fundamental analysis, recognized this massive long-term potential in India's branded jewelry segment. Now, in 2003, Titan hit a massive crisis. They had a severe labor strike at their Hosur factory. The market completely panicked and the share price plummeted. But Jhunjhunwala, he actually met with the management. He understood that the core engine of the business was still incredibly strong, and he bought the shares at an astonishingly low 3 rupees. As the strike inevitably ended and the fundamental business expanded year after year, he held on. He didn't just sell it off for quick emotional profit. He held it while the revenues grew, and eventually that share price skyrocketed to over 4,200 rupees.
Now, there is a much broader lesson here about how billionaires actually build portfolios. Out of a massive portfolio of over 30 different stocks, Titan alone generated roughly 20,000 crores of wealth for the Jhunjhunwala family. Listen closely to this. Billionaires do not have a 100% win rate. There's no way. Many of their investments fail completely, but they rely on a few massive, fundamentally sound winners to completely outshine their inevitable losses.
Section 5, the power of diversification. Don't put all your eggs in one basket. So, if you know that only a few companies will become these massive winners, how do you actually guarantee you catch them? Well, you definitely don't put all your eggs in one basket. Back around 2008, the mega fund Tiger Global completely anticipated the upcoming Indian e-commerce boom. But instead of trying to perfectly guess the one single company that was going to win the whole space, they just invested in multiple competing platforms simultaneously. Look at the breakdown. They put roughly 700 crores into ShopClues, and honestly, that money was essentially lost as the company failed. If that had been their only bet, they'd be completely ruined. But they also heavily invested in Flipkart, and that single investment generated returns of roughly 55,000 crores. The spectacular gain from that one fundamental winner completely dwarfed the total loss from the loser. This is quite literally the math of the wealthy. And this isn't just a one-off trick. Tiger Global repeated this exact proven tactic recently with the Indian discount stockbroker market. Knowing the sector was going to boom, they simultaneously invested in Upstocks, Grow, IND Money, and CoinSwitch. By betting on the entire basket, they essentially guarantee that they capture the massive upside of whichever platform ultimately dominates the space, easily covering any losses they take from the others.
And hey, even if you aren't running a multi-billion-dollar fund, you see this exact same principle in the Nifty 50 index. Over the last 25 years, 40 out of the original 50 companies in that index either failed or were replaced entirely. Yet, because the index itself is diversified, the few massive winners pulled the entire basket up, yielding an incredibly solid 13% compound annual return for regular investors. So it really all boils down to trusting that weighing machine, not the voting machine. It's about sharing risk, analyzing true business growth and efficiency, holding through the short-term noise, and diversifying intelligently. So my final question to you today is this. Are you ready to stop gambling on chart patterns and start investing in real business fundamentals? Thank you so much for joining me for this explainer, and I really hope this blueprint helps you on your own wealth-building journey.
Welcome to This Explainer. Okay, today we're setting out on a seriously fascinating journey to uncover the actual foundational mechanics of how the stock market works. Because, let's be real, if you've ever felt like the financial world is just this giant, overly complex, unapproachable machine, well, you are going to absolutely love this. We're going to completely strip away the confusing jargon, and we're going to break down exactly how an everyday local business evolves into a massive, globally recognized empire, and more importantly, how everyday people, like you and me, get to participate in that exact growth. So here's a quick roadmap of what we're hitting today. Number 1, funding business expansion. Number 2, debt versus equity. Number 3, the ultimate investor bridge. Number 4, a brief market history. Number 5, the engine of growth. And finally, number 6, winning the long game. All right, let's jump right in. I want to kick things off by posing a pretty simple question. How exactly does a local, single-store mom-and-pop shop transform into a billion-dollar corporate empire? I mean, it doesn't just happen by magic, right? And it rarely happens just by saving up the daily cash register receipts. It requires fuel. And in the business world, that fuel is capital.
Imagine this super relatable scenario. You've got this local electronics shop owner running a fantastic little business, but suddenly, bam, fierce online competition from these massive digital platforms starts stealing their customers left and right. Our shop owner knows they absolutely have to build their own digital brand, launch an online platform, and scale up aggressively, basically just to survive. But here's the massive dilemma. Doing all of that, it requires a huge injection of immediate capital. They need money, and they literally need it right now.
Section 1. Funding business expansion. Raising capital. Well, first, our shop owner might, dip into their own personal savings. But let's be honest, that usually runs dry pretty fast. Next, they might pitch the whole idea to friends, family, maybe the local community, just asking them to chip in. And sure, that might raise a few $1,000s. But what happens when the business needs millions or even billions to expand on a national level? Personal and community funds simply are not going to cut it. They have to seek out formal, large-scale financial avenues.
Moving into Section 2, Debt versus Equity, Two Paths to Capital.
So this right here is the absolute fundamental crossroads of finance. On one side, we have debt. Think of this as walking into a bank. You borrow a fixed amount of cash, and you absolutely must repay it over time, plus interest. And the kicker? You have to pay it back regardless of whether your new business expansion is a huge success or a total flop. If you fail, that debt can literally crush your company. On the other side, though, we have equity. This is where the business owner sells the percentage stake of their company to outside investors. By doing this, they are sharing both the risks and the potential rewards.
The really crucial point here is understanding exactly what equity gives you. Raising capital by giving investors partial ownership means there is no mandatory repayment hanging over your head. You're not cutting them a monthly check with interest. This effectively wipes out the immediate risk of bankruptcy if the business hits a rough patch in those early expansion days. The investors become part owners. If the company sinks, well, the investors lose their money. But if the company completely explodes in value and becomes worth 100 times more, those investors' shares explode in value right along with it. It aligns everyone's interest perfectly.
Section 3, the ultimate investor bridge, where capital meets. So where do these companies go? They tap into the global market ecosystem. And this ecosystem is basically made up of a few different types of players. You've got retail investors, which are just everyday individuals like you and me. Then you have domestic institutional investors. These are your large local players like mutual funds or insurance companies. And finally, foreign institutional investors. These are just massive, massive global funds moving serious capital across borders. But all these different groups have one major thing in common. They are constantly on the hunt for great companies to invest their money into.
And this brilliantly illustrates what we call the bridge metaphor. The stock market is, quite simply, the ultimate regulated platform where these two groups get to meet. On one side of the bridge, you've got these expanding companies desperately seeking capital so they can scale up and dominate their markets. On the flip side of the bridge, you've got millions of investors seeking equity stakes in those growing businesses, all trying to build long-term generational wealth. The stock exchange? It's just the meeting place that makes this exchange of capital for equity possible. Section 4. A brief market history. A time-tested system.
Let's take a quick look at this fascinating historical arc, because this isn't some new invention. Way back in the year 1602, over in Amsterdam, merchants wanted to send ships on these highly lucrative but incredibly dangerous ocean voyages. Regular bank loans were just way too risky. I mean, if the ship sank, the company was completely ruined. So they started asking everyday citizens to pitch in small amounts of money in exchange for a share of the profits if the ship actually made it back. It was literally the birth of shared equity risk. And the concept was so powerful it spread like wildfire. By 1875 in Bombay, India, brokers were actually gathering under a massive banyan tree to trade shares of local enterprises, which laid the foundation for modern Asian markets. Today, of course, this whole thing happens in milliseconds across digital national exchanges, but the core principle is exactly the same as it was in 1602.
Moving to Section 5, the engine of growth, how investors earn.
To really grasp this, we have to look at this iconic quote from legendary investor Benjamin Graham, who, by the way, was actually Warren Buffett's mentor. He famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." What he means here is that day-to-day stock prices bounce around wildly based on news, emotions, trends, kind of like a popularity contest, a voting machine. But over 5, 10, or 20 years, the stock market acts as a weighing machine. A company's stock price will absolutely, inevitably reflect the actual fundamental financial weight and growth of the underlying business.
Let's look at a real-world example to really prove this weighing machine concept. Take a company like TVS Motors. Over a period of several years, they drastically increased their revenue, zooming from around 8,000 to over 50,000. And their profits? They soared right alongside those sales. Because the fundamental business was growing so rapidly, actually selling more products and making more profit in the real world, the weighing machine effect completely took over.
And because of that massive real-world business success, the stock price naturally followed suit. Investors who bought equity in TVS Motors and simply sat on their hands and held it saw their wealth multiply a staggering 7 times over a 5-year period. Their money grew for one simple reason: they partnered with a business that thrived. But wait, we gotta consider the flip side here. Remember our chat earlier about the dangers of debt? If a business fails to grow, their revenues start shrinking, and they are stuck carrying heavy bank debt while the weighing machine pulls them down ruthlessly. Looking back historically, companies like Videocon and Arcom saw their shrinking revenues collide with insurmountable debt. The underlying businesses completely collapsed, and as a direct result, their stock prices plummeted to virtually zero. This is exactly why evaluating the actual fundamental health of the business is the absolute key to investing in equity.
Finally, Section 6, Winning the Long Game. Superstar Strategies.
Okay, there is a very surprising, kind of counterintuitive truth about superstar billionaire investors. They do not win on every single stock they buy, not even close. When you actually dig into their portfolios, they often follow a really distinct pattern. A huge chunk of the companies they invest in might just flatline or honestly fail entirely. Another chunk might be just okay, moderate performers. But the secret sauce is that they rely on just 1 or 2 massive exponential winners. Because equity returns can theoretically be infinite, those few massive winners completely eclipse all the other losses, generating just enormous overall wealth. Look at this truly staggering number. The famous Indian investor Rakesh Jhunjhunwala bought shares in a company called Titan during a major market crisis, getting them extremely cheap. But because he understood that the fundamental business underneath was incredibly strong, he held onto that equity for decades as the company scaled its operations massively. The return on that single stock, it exceeded 100,000%. Literally just one stellar equity choice held for the long term while the business grew, built an absolute financial empire, completely overshadowing any of his other investments that just didn't pan out.
So let's quickly summarize the core wealth-building mindsets you should really take away from this explainer. First off, take a breath and relieve yourself of the pressure. You absolutely do not need a 100% success rate to be highly profitable. Second, look for sectors and companies that are just poised for inevitable fundamental growth. When you find them, remember you are buying a partnership in that growth. And finally, the golden rule, stay invested as long as the underlying business is actively expanding and increasing its profits. You are a business partner here, folks, not a gambler at a casino.
I'm going to leave you with this empowering little question to chew on. Knowing what you know now about the actual mechanics of capital, debt, and equity, are you going to let yourself get distracted, treating the stock market like a chaotic daily voting machine? Or are you going to use it strategically as a long-term weighing machine to partner with truly great businesses and build your own wealth? The bridge is right there, waiting for you to cross it. Thanks so much for joining me on this explainer, and keep on learning.
Welcome to This Explainer. Today, we're diving into the actual mechanics of wealth creation. We're going to completely skip all that boring Wall Street jargon and instead look at how money actually multiplies in the real world. By the end of our time together, you're going to see the stock market not as some chaotic casino, but as a perfectly logical engine of growth that absolutely anyone can understand and leverage. So, to get us started, I want you to think about a little historical mystery. What exactly do a 17th century sinking ship in the middle of a massive storm and today's modern billionaires have in common? Sounds kind of like a riddle, right? Well, the answer actually holds the ultimate secret to stock market wealth. It's a secret that has literally built empires, and it's exactly what we're going to unpack for you today. Okay, let's dive into this. Act 1, the origins of risk. Let's jump back to 1602 Amsterdam. Imagine you're a Dutch merchant. You want to send a ship out to find spices, but, the ocean is incredibly treacherous. Cyclones, pirates. If your ship sinks, you lose absolutely everything. Now, taking a traditional bank loan back then was way too rigid. If the ship went down, the bank still wanted their money, and you'd be totally ruined. So these merchants came up with a brilliant, game-changing idea. What if they shared the risk with the public? You fund my ship, you get a slice of the profits. If it sinks, hey, we all lose a little bit, but nobody goes bankrupt. Fun fact, this one simple idea made the Dutch East India Company the most valuable corporation in human history. Adjusted for inflation, they were worth way more than Apple and Microsoft combined today. And this viral idea spread like wildfire to London and eventually all the way to India. In 1875, merchants actually gathered under a banyan tree in Bombay to form the Bombay Stock Exchange, which completely laid the groundwork for the national stock exchange we know today.
And this brings us right to the ultimate business survival tool. When you look at a company's balance sheet, which you can basically think of as the structural foundation of a business, the biggest flashing red flag is almost always risky debt. If a business is built on a heavy foundation of borrowed money, meaning strict liabilities that absolutely must be paid back, that structure is eventually going to crack under the weight of an economic storm. I mean, why do companies go bankrupt? Almost always, it's debt. But if a business raises its cash through equity, meaning they just share a piece of ownership with the public, that foundation becomes super flexible. They literally can't go bankrupt that way because there's no rigid loan demanding repayment. Debt will absolutely sink a business when times get tough, but equity distributes both the risk and the reward. And that's exactly why legendary founders, from those early Dutch merchants all the way to Dhirubhai Ambani building Reliance, turned to the public for equity. They wanted massive, explosive growth, but without the crushing weight of debt dragging them down.
Moving on to Act 2, the weighing machine. So there's this legendary quote from Benjamin Graham. He's the guy who actually taught Warren Buffett. He said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Basically, day to day or even hour to hour, the stock market is literally just a giant popularity contest. Prices bounce all over the place based on rumors, news snippets, and just pure panic. But over the long term, we're talking years and decades here, all that random noise just fades away. The market transforms into a weighing machine that measures the actual heavy reality of the business itself.
So, the million-dollar question is, how do we actually measure that weight? Well, we do it through fundamental analysis. This means you got to know how to read 3 absolute core gauges. First up is the profit and loss statement. Think of this as the business's daily diary of operations. It shows you, plain and simple, if they actually made more money than they spent over a specific time. Second is the balance sheet, which we just touched on. That's the X-ray of their overall health, comparing exactly what they own against what they strictly owe at this very second. And finally, the cash flow statement. You can think of this as the company's pulse. A business might look profitable on paper, but if cold, hard cash isn't actively pumping into their bank account to pay the bills, it's going to flatline. We contrast this deep structural reality check with technical analysis, people staring at those complex candlestick charts, trying to guess short-term price jumps. But if you look at the real billionaires list, you are going to find folks who mastered reading those fundamental financial statements, not the short-term chart guessers. Because ultimately, the stock price strictly follows business reality.
All right, Act 3, the anatomy of growth. We're going to look at the stark contrast between massive corporate winners and spectacular failures.
And this brilliantly illustrates our point. Take a look at TVS Motors. Over a 5-year stretch, their real-world business just exploded. And you could see this directly in a phenomenally healthy profit and loss statement. Their top line, which is the actual raw sales cash coming in the front door, grew from 8,000 kra to a whopping 50,000 kra. And that massive top line essentially yanked their bottom line, the actual net profit, straight up with it. It skyrocketed from 187 kra to 3,000 kra. This kind of massive growth created a tidal wave of positive cash flow that the market just literally couldn't ignore. Because the underlying business became drastically more profitable, their share price went up 7 times over those 5 years. The stock price was just acting as that weighing machine, weighing all that brand new profit.
But we've got to look at the dark side too. Remember Videocon? I mean, they used to be in literally everyone's living room. But if you actually popped the hood and looked at their financials, the story was pretty grim. Back in 2011, they had 12,000 crore in revenue. But as the years went by, that revenue shriveled up to 5,600 crore. And even worse than that, their cash flow completely dried up, leaving their balance sheet to just collapse under the crushing weight of massive debts. It proves without a doubt that a bleeding profit and loss statement will eventually destroy a stock price. Videocon stock inevitably crashed down to single digits, completely regardless of whatever the short-term popularity contests were saying at the time.
This brings us to Act 4, the billionaire's secret. Because honestly, the greatest investors don't actually win on every single stock they pick.
Take the late, legendary Indian investor Rakesh Jhunjhunwala. His portfolio had dozens and dozens of stocks in it, and a lot of them completely failed or, they just did absolutely nothing. But out of a massive net worth of nearly 67,000 crore, a truly staggering 20,000 crore came from just one single company, Titan. It's wild. A huge portion of his vast wealth wasn't from picking 50 perfect stocks. It was from landing one massive, phenomenal winner that totally made up for all the losers and then some. And the story of how he actually acquired Titan is just incredible. So back in 2003, Titan was a solid company, but they got hit with a massive labor strike at their factory in Hosur. Production completely ground to a halt, then news got out, and the stock market, acting exactly like a panicked short-term voting machine, freaked out. The share price just plummeted. But Jhunjhunwala, he went and met with the management, took a hard look at their fundamental report card, and realized something crucial. The strike was temporary, but the underlying potential of the business, that was permanent. So he bought in at practically nothing, just 3 rupees per share. He held on patiently as the actual business grew and expanded its jewelry segment. Today, that exact same share is worth over 4,200 rupees. That is a 1,000,000% return. And it happened just because he had the patience to hold on to a fundamentally strong business right through all the temporary noise.
Now, what's really interesting about this slide is that it's not just individual billionaires doing this. Look at Tiger Global, one of the biggest investment firms on the planet. Around 2008, they absolutely knew that e-commerce in India was going to be massive, but they didn't know exactly which company was going to take the crown. So they invested 700 crore into ShopClues. The result? Total complete loss, money gone. But they also put 10,000 crore over time into Flipkart, and the result there? A 55,000 crore profit. That one massive win on Flipkart completely eclipsed the loss they took on ShopClues.
And they've actually repeated this exact same strategy recently with the discount brokerage sector in India. They place bets on Upstocks, Grow, IND Money, and CoinSwitch. Now, they know for a fact that not all 4 of these companies are going to dominate, but by betting on an entire emerging sector, they made sure they had a ticket to the big game. And already, their investment in Grow has hit 7x returns. It's the exact same principle. One massive winner in a fast-growing space will easily pay for all the losers. It's really all about being right on the big macro trend and just holding on for the ride.
And this principle applies perfectly to regular investors like us, too. Just consider the Nifty 50 index, which tracks the top 50 companies in India. If you had invested in that 25 years ago, you might be pretty shocked to learn that 40 out of those original 50 companies literally vanished from the index. They failed, they shrank, or they just got replaced. Only 10 of them survived. But here's the crazy part. Despite an 80% casualty rate in the companies you held, those remaining winners carried the index so high that you would have still generated a 13% compounded annual growth rate. That right there is the absolute ultimate power of holding on to fundamental growth. So we return right back to where we started. The stock market isn't magic. It's literally just businesses raising capital to build ships, build factories, and grow their actual revenues and profits. The math is incredibly simple. If the underlying business grows, over time, the share price is going to follow. So my final question for you in this explainer is this. Now that you know the billionaire's secret isn't some magical crystal ball, but rather the sheer endurance to hold fundamentally sound businesses, do you have the patience to weather the short-term storms, ignore the noisy voting machine, and let the weighing machine deliver your ultimate reward?
All right, let's dive right into this explainer. If you've ever felt totally overwhelmed by those flashing red and green numbers jumping around minute by minute, hey, you're definitely not alone. Today, we're cutting straight through the daily noise to uncover the absolute, proven mechanics of picking winning stocks. We're going to leave that gambling mentality in the rearview mirror and focus entirely on the actual, undeniable mechanics of long-term wealth creation.
To set the stage, we've got to talk about the godfather of value investing himself, Benjamin Graham. The guy who literally taught Warren Buffett. This quote is absolutely brilliant. It perfectly captures the undeniable truth of investing. You see, short-term volatility, it's just a chaotic illusion. Every single day, the market is essentially a voting machine. It's driven by panic, excitement, and wild rumors. But in the long run, it's a weighing machine. It reveals the quiet, undeniable truth of what a company is actually worth.
So this brings us to the ultimate showdown. On one side, you have core financial evaluation. This is where we roll up our sleeves and look at real business metrics, sales, profits, overall sector growth.
On the exact opposite side, you have technical analysis, or chart reading. This is trying to predict short-term price movements using candlestick patterns and trend lines. And the stark reality here? While charting might give you a quick speculative thrill, a little adrenaline rush, evaluating the actual underlying business is the only proven, reliable roadmap to long-term wealth.
This means assessing a business's fundamental health has to be your golden rule. Think of fundamental analysis as the ultimate financial lie detector test. It completely cuts through the emotional roller coaster of the stock market to measure the true beating heart of an enterprise. Instead of shadowboxing with short-term technical patterns and, frankly, just squiggly lines on a screen, you're deeply evaluating a company's revenue and profit growth over a long period. Because at the end of the day, actual business growth intrinsically dictates stock price growth. Reality is always going to catch up to the underlying value.
A tale of two extremes. Let's actually look at these fundamentals in action through some high-stakes, real-world case studies. We'll see exactly what happens when the underlying business collapses and what happens when it absolutely explodes.
Let's start with a massive cautionary tale, Videocon. I mean, this was once an absolute household name, right? But their revenues went into a completely devastating freefall. We're talking about plummeting from 12,000 crore all the way down to roughly 5,600 crore. And that dragged their profits straight into the negative. As an investor, your main mission is to spot tragedies exactly like this before they wipe you out. When shrinking core revenue is directly destroying a business, literally no amount of technical analysis or lucky timing is going to save you from the inevitable crash.
And we see this exact same thing playing out right now with modern tech startups. Take Ola Electric, for example. Despite all the massive hype and early excitement, the fundamental losses were just staggering. Revenue stalled out, cash bleed accelerated, and as a company's fundamental losses pile up, the market mercilessly slashes its valuation. So speculative investors who bought in at the peak of 130 rupees, they found themselves completely stranded when the stock plummeted to roughly 40 rupees. Like we said, the weighing machine always wins.
But let's flip the script for a second and look at a huge business triumph. Look at TVS Motor. While others were struggling, TVS leaned heavily into their market, dominated the electric two-wheeler sector, and watched their underlying profits absolutely skyrocket. We're talking to jump from a modest 187 crore to a staggering 3,000 crore. Now that is exactly what a fundamentally thriving business looks like under the hood. And this brilliantly illustrates how rapid fundamental growth translates directly into wealth. Over just a 5-year period, long-term investors who recognized those growing profits were rewarded with a massive 7-fold return on their investment. That's a 7x return. It's not magic. It's the direct, undeniable mathematical result of a company multiplying its true underlying profits.
The secret math of billionaires. Now that we've got the core mechanics down, let's uncover how the absolute titans of finance actually wield this weighing machine to build unimaginable wealth.
So, do legendary investors win on every single stock they buy? You might naturally assume that market billionaires have this flawless Midas touch, right? Like every single stock they pick just turns to gold. But the mathematical reality of their portfolios is a total plot twist. The truth is, they lose. Actually, they lose a lot. But their secret weapon is exactly how they manage those wins and losses, through the strict lens of fundamental growth.
Take the late, legendary Rakesh Jhunjhunwala and his incredible journey with Titan. Back in 2003, Titan was facing a massive labor strike at their factory. The stock completely tanked to just 3 rupees. While the whole market was panicking, Jhunjhunwala looked squarely at the fundamentals. He saw great management, strong backing, and a huge untapped jewelry market. So he bought in. By 2005, it surged to 33 rupees. Now, most people would have sold right there for a massive 10x profit, but because the underlying business was still growing rapidly, he held firm. Today, that stock peaked at over 4,200 rupees. That is a mind-bending return of over 100,000%. Insane, right?
But when you break down his actual portfolio, the reality is even more astounding. Out of a net worth of nearly 67,000 crore, roughly 20,000 crore came from Titan alone. The secret here is that out of dozens of failed or just mediocre bets, and believe me, he had plenty of investments go straight to zero, you really only need a few fundamentally explosive titans to generate the vast majority of your wealth.
And it's not just individual billionaires doing this. Massive institutional firms like Tiger Global use this exact same fundamental logic. Back around 2008, they knew the Indian e-commerce sector was fundamentally primed to explode. But instead of rolling the dice to guess the single technical winner, they used a basket strategy. They invested heavily across the board in Flipkart, ShopClues, and Amazon India.
They knew that massive overall industry growth would eventually crown a winner big enough to pay for absolutely everything else.
Here's the brutal but brilliant math of that strategy. Their investment in shop clues, well, it basically went to zero, totally wiping out a 700 crore bet. Ouch. But their investment in Flipkart, they poured 10,000 crore into it over time. And because Flipkart captured the fundamental growth of the entire sector, that investment turned into roughly 55,000 crore. So even when massive investments fail completely, the spectacular, fundamentally driven growth of a single winner easily covers all those losses and still generates an incredible fortune.
Now, if you're still somehow on the fence, look at the granddaddy of them all, the Nifty 50 Index. Over the last 25 years, get this, 40 out of the 50 original top companies have completely vanished from the index. They failed, they shrank, or they were just simply outpaced. Yet, despite an 80% failure rate of its original lineup, the index itself still returned an incredible 13% compounded annually. It is endlessly fascinating. While individual companies frequently die out, the fundamentally strong survivors always pull the entire market upward.
Your ultimate investing verdict. Let's bring all of this together to define your actual actionable roadmap for long-term financial success based on everything we've unpacked today. By adopting 3 core steps, you can finally step away from the chaotic casino of daily trading and align yourself with the true, unshakable mechanics of wealth generation. First, ignore the daily voting machine entirely. Just tune it out. Second, obsess over evaluating core revenue and profit growth. Remember, if the business grows, the stock is naturally going to follow. And third, once you find those fundamentally strong titans, hold on to them for the long term. Let the magic of compounding do all the heavy lifting for you. So I leave you with this final thought to really ponder as you decide how you want to build your future from today onward. The evidence is totally clear. The math is frankly undeniable, and the choice is entirely yours. Will you keep gambling your hard-earned capital on the daily voting machine, constantly reacting to every little blip of short-term noise? Or are you finally ready to step onto the ultimate weighing machine of fundamental growth? Thanks so much for exploring this explainer with me today. I highly encourage you to start viewing your investments not as squiggly lines on a chart, but as real, living, breathing businesses. See you next time.